Right, so in this video, I'm going to go over the top 7 mistakes I see from years of working retirement planning with clients, so that you can hopefully avoid these mistakes and it might help you retire earlier. So let's start the countdown from 7 to 1 with number 7. So number 7 is not completing a death benefit nomination. Now, this might seem minor for a lot of you, but for some, it's a really big thing to get ticked off. This relates to if you pass away, who your pension pot will go to. The trustees or the scheme administrators of what's called a money purchase plan, which is where you pay in, your employer pays in, and it's a non-guaranteed pot. Well, they will typically have discretion over the payment of the death benefits, unless a binding nomination has been made. This is a structure that keeps pensions outside of your estate for inheritance tax. Now, a nomination form, often what's called a letter of wishes, allows the pension scheme member to tell the trustees who they would like to benefit on death. This nomination helps guide scheme trustees with their decision making. Now, for defined benefit pensions where there is a guaranteed pension, there may also be a nomination for any death benefit lump sum. But overall, the death benefits can be more complicated, so it's worth checking your scheme rules. The reason this can be crucial is that if you have non-dependents who you want to receive your pension, or if you have more complex family arrangements where it isn't immediately obvious who the benefits would go to, such as normally like your spouse, the trustees may struggle to figure out who should benefit, and there is a higher chance it might not be the family member you want, depending on your situation. So nomination forms can be found online, usually with the provider, and I'll give you some examples here, or requested through your scheme. So number 6 is not understanding effective tax rate. So one thing I've heard a lot of people say is that, yeah, you get tax relief from pension on the way in, tax on the way out, what's the benefit? Well, this is why effective tax rate matters. And this is just about the effective rate of the tax at the end. So because a pension is tax deferred, you pay the tax later, but under current rules, you can get a tax-free lump sum, which could be up to 25% of the fund. And, we have some caveats. And the rest after that is normally taxable. So you've got to remember, because you're going to be taking this likely when you've retired, you may be a higher rate taxpayer now, but a basic rate or even a non-taxpayer in retirement. And that means you might have some of your personal allowance when you retire, which is for this year, £12,570. And that's the amount of allowance you can get taxable income that can be paid tax-free. So there's a good chance some of this income could fall into this. So let's just keep this super simple. And let's just assume you have £30,000 of which you received higher rate tax relief. So you received 40% tax relief on the full £30,000 contribution. So that means you actually contributed £18,000 before the tax relief. Now, let's assume that you retire at 60 and you have no other income. For this year, and let's just say it's this tax year, £12,570 would sit within your personal allowance, so that would be taxable, but it comes through tax-free. We'll also assume it's a defined contribution pension, and with it, 25% comes through tax-free, so that's £7,500. Now the rest, the £9,930, yes, it's taxable, but it's going to be taxable at 20%. So it means that's £1,986 tax you paid overall. So you've had 40% tax on the way in, but due to a mixture of the tax-free lump sum and your personal allowance being available, the effective tax rate in this example was just 6.62%, or that £1,986 figure. Now clearly these are just examples and every situation will differ depending on income, tax-free cash availability, other taxes like lifetime allowance, but it is very much something to be aware of. Okay, number 5, thinking the state will provide. So the full single tier state pension, which can be more or less depending on your accrual, and if you want to watch a bit more about that, watch my video on state pension explained, is currently about £778 per month in a tax year. So okay, so let's say there's 2 of you and your couple, and you've got no mortgage, well, £1,500 a month, not too bad. However, for most of us, that isn't really going to be enough to have a great quality of life, and it's mainly going to be covering the basics. It's also only payable at state pension age, which for you is likely to be 66, 67, or maybe even later. And it also opens up the door, if you're relying on this, that your partner, you could get divorced or they could sadly pass away. So while the state pension is a really useful part of the overall retirement planning, it probably won't provide enough on its own, which is why you need to plan ahead. Okay, number 4, losing your pension. You might be surprised this isn't number 1, but it is actually strangely common because we often move around roles a lot more, and it's actually quite an easy win, and it can have a massive impact if it's relevant to you. I've had clients who've literally had thousands of pounds in a pension they'd forgotten about. So if you're thinking, yeah, actually I did pay into a pension with that company I worked for like 15 years ago, what I would suggest is you can follow this link to the pension tracing service, where you can put in your ex-employer's name and find their contact details to check if you have pension benefits with them. So number 3, not checking what you're invested in. This is a big one. So one of the big mistakes is just thinking, yeah, I'm in my current pension scheme, I'll just leave it. No, you need to make sure you check what you're invested in and make sure this is also in line with your goals. You've got to factor in this may be a long-term investment because it's a pension that you might not be able to touch for many years. For example, if you're 40, you might not be able to draw down the benefits for 17 years, 20 years plus. So the question is the volatility, the ups and downs along the way, as much of a problem? While you always have to be comfortable with the level of risk you take, and if in doubt, get advice specific to you, you have to weigh up the risk carefully here, and especially if you literally can't touch it for many years. What I'm saying is asset allocation, what you're invested in, this matters. Since 1900, the returns after inflation for equities, which are shares and companies, has been 5.2% a year. For bonds, it's been 2%. So the inflation-adjusted return over 30 years, if you were on £40,000 and you contributed 8%, would be this if you're in equities. But it would be this if you're all in bonds. So whatever your individual choices, the point I make is what you are invested in matters. And it is your responsibility for a lot of workplace schemes to decide this. So you need to check and make sure it aligns to your goals. Another key thing to be aware of here is that a lot of providers have a default fund, for example, like a lifestyle fund. Funds like this can often be a default option for workplace schemes. And what these funds do is that in the first 5 years, they will put you in what's called a foundation stage, where basically you will be in lower risk assets. And the idea of this was apparently that if people see dips in their investment in the earlier years, they may stop investing. Personally, I think this is a bit bizarre, but they're the rules of those particular funds. Now, towards retirement, these funds are also designed to move out of more volatile assets as you approach retirement. So they move generally down towards cash. The idea was originally is that what you will be doing with your cash at that point is buying an annuity, buying a guaranteed income for life. So you need to take your risk out of high risk assets such as shares. The question is, are you going to be buying an annuity? And is that the right strategy for you based on your retirement plans? It's your responsibility in a defined contribution arrangement to pick the investments unless you take advice. And it's really important to make sure that they are right for your goals. Okay, now down to the last couple. Number 2, not maximizing employer match, the free money. And this is a huge mistake. A lot of employment contracts will have in the rules that if you pay a certain amount, your employer, will match the contribution. Not all, but it's definitely worth a check. So let's say you're earning £40,000 a year and you get 20% tax relief on any personal pension contributions. With this assumption, we're going to assume that you just contribute from 40 to 60 and you get a 5% return after charges. I'm not trying to set the world alight with these examples, but it's just a steady return to give you an idea. So the first example, you're on the minimum auto-enrollment contributions amount for this year. So you pay in 5%, but actually it's only 4% because you get 1% tax relief as part of that 5%. Your employer pays 3%, and that means your total contribution is 8%. And that's option 1. Now option 2, let's assume instead that there's an 8% match as part of your contract. So if you put in 8%, they'll match it. Now you've got to increase your share here compared to the first option, but you've only got to do it by 2.4%, as the contribution rate to get to 8% is just 6.4% before basic rate tax relief, because you get some tax relief to bump it up. And then in this example, your employer matches it. So effectively they double what you put in. So the maths of it is if you contribute £133.30 per month over 20 years and get a 5% return, and your first option with that contribution, without tax relief, you would have had £54,790.79, and of that, £22,798.79 is growth. So of that £54,000, you put in just under £32,000 or £32,000 for some rounding. Now, your end amount when factoring in tax relief and the employer contribution is £109,851.58. And of that, £45,597 is growth. And that is due to the growth and also the employer match. Okay, so option 2, same amount earned, you're going to put in 6.4%, which gets you to 8% after tax relief. So your sacrifice to get to that 8% has been an extra 2.4%. That's actually just £80 a month based on these figures, pre-tax from your take home. So the end amount after 20 years, £219,204.26. Over 20 years, it cost you £19,200 extra of contributions to achieve that figure. But because your employer matched it, it gave you the free money, along with some growth and the tax relief, it equated to over double your first option. So the question is, would you want to have more than double the amount you have in retirement by sacrificing, in that example, it was just £80 a month? But it's just to show how powerful employer match can be and how much you could be missing out if you're not maximising it. So, number 1, not planning in advance. And I've got to put this down as number 1 because it's the biggest issue, because simply not planning enough time ahead of retirement or at retirement is the biggest problem. The thing is, with pensions, I understand they're not top of the priority list, but if you think about it, imagine if you got paid at 10% less each month. How long would you let that get on for if you saw it in your take home? This is effectively what you're doing with pensions. If you're investing in the wrong fund or if you're not using tax advantage or employer match, it's just that you're going to have the problem later down the road. And from a financial planning perspective, that there is obviously a lot you can do even if you have a client who's in their 60s and they haven't saved into the pension. But it's nowhere near as powerful as what you can do if somebody starts early, because the two biggest tools at most people's disposal are the tax efficiency of the pension and then compounding, the ability in a tax efficient environment for the pension assets to grow. So if you don't want to get full advice based on your own personal circumstances, there are some links, for example, PensionWise, which is an impartial government source, which can help you with a bit of guidance. So I will put them in the description as well. I hope that's given you something to think about. This has been Principles Personal Finance. Thanks very much for watching. See you next time.